Well, if you bought, $120 silver or $5,600 gold, I don't think you were necessarily late to the party because the party's not over. But I think you're going to see a steady upturn in demand. As I said, private investors, both retail and institutional, I think, the hedge funds, the pensions, the endowments, I think they're going to start moving into gold. The bond traders are kind of walking past it too, maybe not as blindly as the equity traders, because I think if the bond investors really perceived the gravity of the threat, yields would already be a lot higher than they are right now. I still think that the U.S. government is getting off cheap being able to borrow money for 30 years at just 5%. You could go look back at what the U.S. government was paying to borrow money in the 80s and the 90s, let alone the 70s. And it was paying a lot more than that. But we were a lot better credit risk back then because we had a lot less debt. And therefore, we didn't have to print nearly as much money to service it. So I think at least the bond market is starting to pay attention, but I think yields are going a lot higher on the longer end in particular. And eventually the stock market is going to notice that, and you're going to start to see some weakness there. And then I think gold is going to break out of this consolidation because investors have been focusing on the nominal increase in yields as if somehow that is a negative for gold. It's not. Nominal interest rates are irrelevant. It's real interest rates that count. And I think real interest rates are falling, even on the long end, because inflation is accelerating a lot more than yields are rising. Meanwhile, the Fed has stayed pat. The Fed hasn't hiked rates, and that amounts to a rate cut. And all of this is bullish for gold. Yeah, you think they would have retired transient from the vocabulary over there at the Fed and come up with a different adjective to describe it. But the only thing that's transient is the rate at which rates are going up, because I think they're going to go up a lot faster in the future. So I think the new Fed chair has a big problem on his hands, as does the Secretary of the Treasury. I think we're going to be looking at a sovereign debt crisis and a U.S. dollar crisis, I think, before the end of the Trump term.
Behind the scenes, the real battle is in the bond market. America's unprecedented debt forces massive yearly borrowing. Historically, governments print money to suppress borrowing costs, but rising yields suggest investors are rapidly losing confidence. The U.S. could soon face a dangerous, globally destabilizing sovereign debt crisis.
Well, if you bought $120 silver or $5,600 gold, I don't think you were necessarily late to the party because the party's not over. But sure, yeah, you should have bought. You didn't have to wait for those spikes to buy. And generally when we have spikes like that, I tell people, look, you could buy, but, don't buy everything. I mean, keep, money aside so that if it comes down, you could buy more. And, I had been advising my clients for over 20 years to steadily buy gold and silver when they have extra money. And so, yes, you might be buying the highs sometimes, but you're also buying the pullbacks. I started getting people into gold under 300 and silver under $5. So when you look back at those buys, they were pretty good. And even if you bought the highs along the way, a lot of those highs look pretty low, looking back from where we are right now. But, usually what motivates people to move is something happening with the price. So if the price really starts to shoot up, people get afraid that maybe they're missing out on a bigger move and they move quickly. And that's, just how the markets work. And sometimes when the market is going down, that's when people should be buying more. But then people get too afraid that it's going to keep falling. And so they don't buy, or worse, they sell, right? That's the worst thing you could do is panic and get out. Because these are long-term trends, that are going to continue, I think, for a long, long time. Gold, when, the country started, we're about to have our 250-year anniversary, although that's of the Declaration of Independence. But the first coinage act of 1792, the gold was $20 an ounce, and it stayed $20 an ounce up until 1934. And then it became $35 and it stayed there until about 1970. But ever since then, the dollar's been collapsing, and now you need $4,500 to buy an ounce of gold. The dollar's already lost 99% of its purchasing power. It's probably going to lose another 99% from here. And so who knows, to multiply gold by 100, that's where ultimately it's going to go. The question is, how much longer is it going to take to get there? I think the dollar could lose the next 99% of its value a lot faster than it lost the first 99%. So, you got to just keep on buying. But sure, try to buy the pullbacks more than the rallies. But if it takes a rally to get some people off the fence, then that's fine. I'm confident that even if you bought the highs, you're still going to be glad that you did, in a few years. But in the meantime, buy more, right? That's what pullbacks are for. They give you an opportunity, to get a better deal and average your costs down. Well, I don't even think it's going through paper market either. I think, there's just not a lot of demand. Now, things did pick up. I mean, if you look at my own experience with Schiff Gold and our sales there, 2024 and most of 2025 were pretty weak years for sales. I mean, the big year that we had was 2020. So when COVID broke out, there was a big uptick in retail demand for gold and silver. So we saw that, and then it kind of fizzled out, and it finally started to come back earlier this year, late last year, early this year, when we saw the big moves up. Then we finally saw an uptick in retail demand, which also coincided with a short-term top, which, is not atypical of the way markets typically trade. But I think that even though demand has come off a bit, it's higher now than it was. And I think it's going to continue. I think this correction has maybe scared a few people out of the market. And I think the media has, highlighted the correction to try to convince people, oh, look, gold's down $1,000. Look where silver, it's not a safe haven. Silver and gold, they were supposed to go up when we had a war, and instead they went down, which is true because they went up so much before the war. It was pretty obvious something was going to happen with Iran, in the months leading up to it. So I think gold, and silver, kind of rallied off, of that. And then when when the rumors became a fact, there was, a tendency to sell, which is typical market behavior. But I think you're going to see a steady upturn in demand. As I said, private investors, both retail and institutional, I think, the hedge funds, the pensions, the endowments, I think they're going to start moving into gold. And a lot of that money is going to come out of fixed income, not so much out of the stock market, but out of the bond market. And even you saw, it was about a year ago, I think it was Morgan Stanley that talked about tweaking the 60-40 portfolio to make it 60-20-20, where you cut your bond portfolio in half and you put the other half in the gold. I think investors are going to be looking for a safe haven, for an inflation hedge. And I do think we're going to get a big decline in the stock market at some point. We're at nosebleed valuations, in a big AI, tech bubble, that's at some point going to burst. And when the money is leaving, where's it going to go? I think it's much more likely to go to gold, than U.S. dollars and certainly U.S. treasuries. Yeah. I think getting, Massey kicked out of Congress sends the wrong message to our creditors, because he was the lone voice for fiscal responsibility in the Republican Party. I mean, he was the sole vote against the big, beautiful bill, which was a disaster as far as increasing government spending. Republicans got elected criticizing the excess spending of Biden, yet Massey was the only one that wanted to reduce that spending. All of the other Republicans voted to keep all of the Biden era spending that they objected to, and then add some more for good measure, making it worse. And so I think one of the main reasons they were able to get rid of Massey was because he voted against that bill. He's not a Republican. He voted against this tax cut. It wasn't a tax cut. The big, beautiful bill was a tax increase because it made government bigger and more expensive. And you measure the cost of government by what it spends. not by what it collects in official taxes, because the difference is made up through inflation. And Thomas Massie didn't want to hit his constituents or the country with the massive inflation tax necessary to pay for the big, beautiful bill. But the message that it sends to our creditors is fiscal responsibility is dead and buried. Certainly the Democrats are not going to be fiscally responsible. They love big government. The more the government spends, the better. The party of fiscal restraint was supposed to be the Republicans, but that's gone out the window. And so everybody can tell that we're never going to, get our house in order. We're not going to, prevent this, fiscal, collapse. We're just going to keep on driving the train until we go over the edge of a cliff. And so people want to bail out. Central banks don't want to own our currency. They don't want to own our bonds. And soon nobody will want to own our currency or our bonds, even Americans. And, they'll be rushing to get rid of their dollars and getting into gold, getting into silver, getting into hard assets or even other fiat currencies, to avoid that inflation tax. Well, remember, after that, silver went on to top $125 an ounce after that interview. Yeah. Now, what's significant is not, silver's fallen back to 76. What's significant is that we blew through 50. And, that was really the overhead resistance dating back to the Hunt brothers in 1980. And we couldn't even get to 50 in 2011 when gold went above 2000. But then we blew through it, like a hot knife through butter. And we went way up to 125. So that was a massive breakout. It doesn't surprise me that we couldn't sustain that big a move in such a short period of time. But what should be impressive to anybody is that we never went back below 50. We never went anywhere near 50. We broke out and now we're consolidating really in the 70s. And we've had, we almost got back up to 90 a week or two ago. So I think this is a beautiful breakout and consolidation in the silver market. And this is going to resolve itself with another big up move. So that $125 peak, that's not the peak for silver. That's just the first stop on a long road that I think is going to see much, much higher prices for silver.
Fears are growing that the massive tech rallies driven by artificial intelligence are actually another speculative bubble. If the AI trade suddenly unwinds, trillions of dollars in paper wealth could evaporate instantly. This extreme uncertainty is pushing smart investors entirely toward hard assets like precious metals and energy.
Well, there is no exit. I mean, the Fed and Congress, I mean, it's not just the Fed, but they put us in this situation where there is no way out, because you have two doors. One is hyperinflation and the other is depression, a financial crisis, a complete collapse of the economy. Not that hyperinflation avoids that. It just maybe delays it a bit and it takes on an even worse form. But there is no graceful exit. There is no soft landing. That's why nobody wants to deal with the problem. A former Secretary of the Treasury, Hank Paulson, recently came out and said that the U.S. needs to develop a break the glass kind of emergency plan to deal with the situation when foreigners no longer want to loan us money and they don't want to buy our bonds. So we have to figure out an emergency plan. He didn't even, talk about, hey, let's try to avert this crisis. Let's get ahead of it. Let's make some cuts to government spending so that we don't have to face this crisis. He just resigned himself to the fact that the crisis was inevitable, that the government would never do anything to prevent it or preempt it. And it was just, let's brace for the impact of this crash. But the problem is, I don't think there's a plan that is going to work. We are going to have to pay the piper, and it's a big bill. Because, we haven't paid it in decades. We keep kicking the can down the road. And, you said 38 trillion. The national debt is now 39.3 or something like that. I mean, we're going to hit 40 trillion in a matter of months. I think we're going to hit 50 trillion before Trump finishes his term. And that's going to be because the Fed is going to be back in QE mode, monetizing a lot of this debt that the rest of the world no longer wants to finance. And that's where a lot of the inflation is going to come from. You know, right now, they've got an excuse. They can blame it on the war with Iran. And obviously that's not helping. But I think the Iran war was more of a catalyst for the breakout in oil and the breakout in bond yields that would have happened anyway. And if it wasn't Iran, it would have been something else. And a lot of people have a foolish view that as soon as the war is over, everything's going to be great. Oil's going to come crashing down. Bond yields are going to come way down. I don't think that's going to happen. I mean, you may have a little bit of a blip, but then I think it's off to the races. I think oil's going a lot higher, and so are bond yields, even if the war ends, which, you know, who knows if that's actually going to happen anytime soon. But even if it does, I think that these trends are going to remain in place.